Any advice and information from this podcast is general only. It has been prepared without taking into account your individual circumstances and needs. Before acting on any advice from this podcast, you should assess and seek advice on whether it is appropriate for your needs, financial situation, and investment objectives.
All right, welcome back to another not another finance podcast. This is why Yannick always starts the podcast.
Yes, we're going to get into it. John's not going to get into it, but
Yeah, we've got a special guest today.
happy to be here.
Yeah, it's Dan the man.
That's me, Dan Perkins.
And Dan, for yourself, well, Jess will probably give more of an intro, but definitely the maestro and things, lending, mortgages,
Yes.
all kinds of stuff. A few of us have definitely gone through you, and you're pretty busy in the scope. But I guess you're currently at Domo.
Yeah, that's right. So running my own sort of one-man band, Lumo Brokerage. We're in the middle of a bit of a changeover to operate as a group. So it would be Lumo Finance, which is really exciting.
You heard it here first.
Yeah, the big announcement. But yeah, there'll be some probably billboards of our ugly mugs getting around and maybe a radio ad or two. But yeah, we're sort of going to go a bit harder in the coming week or two with the big announcement. But it's very exciting stuff. Good to get everyone kind of like working as a team. A few one-man bands coming together under one brand, so to speak. You know. So yeah, very exciting.
It's, that is a bit, when this hits Spotify and our
Yeah.
two finals. I don't know how many.
Yeah.
With that intro, the big part of why we sort of brought you on, besides how brilliant you are with everything sort of
Thank you.
loans and stuff.
Yes.
I think you got my home loan, like 1%. No, that's a joke.
No, yeah.
So look, there's a heap of brokers out there, there's a heap of banks out there. When we talk about real estate, there's a lot of lending out there.
Yeah.
But it's like what we talked about in our previous episodes, Jesse. There's a difference between a few things like super funds. There's good ones and there's kind of not so good ones.
Yeah.
And for yourself, as a non-biased opinion from personal experience, your brokerage, and I think even JMAC's brokerage experience has been pretty.
A little bit more human. Yeah.
It's really
That's what we're trying to bring.
So that's why we definitely thought we'd try and just have a bit of a chat with you.
I love it.
Insight, experience.
Yeah.
Talk about as well.
Yeah.
Do
100%.
could we have like a bit of a background on you for all
Yeah.
of our listeners?
I think it's easy for the three of us. Excitingly, we're in the Evergreen office, obviously. Me and Evergreen go way back. I started when it started with Roshan, so a lovely kind of probably a year and a bit working with him, paraplanner, like admin, getting everything set up and running when he was kicking it off on his own.
The business owner.
Yes.
Yep.
And since then I sort of reverted. Like I love the financial planning model while I was working in it, but my thing's always been more relationship, like just kind of back and forth with relationships. So I moved out of financial planning and started working for Sun Super, which then became Australian Retirement Trust. But the job was sort of managing corporate super plans, which you sort of end up with some big name, like national company, multinational company names. And really awesome to I suppose, even just as life experience, seeing how businesses sort of like Google, Woolworths, that sort of scale function. And then just naturally, I'm not a very bureaucratic person, but as time goes on in big employers, you sort of find that systems slow down and trying to solve problems gets a bit sort of sticky. So I was keen to go into my own business. And one of my good mates, Dylan Papalato, he'd just started broking. So
Shout out to Dylan.
yeah, love you, Dylan. We were sort of yarning all the way through that. And then as time went on, and I saw the value in it and what you could do for people, it was really appealing to me. So the brokerage started probably 2 years ago. And since then, yeah, it's really just trying to, I suppose, coming into things, being a helpful person really opens more doors than you probably would ever expect. So the idea at the start was maybe focusing more on home loan, managing that for people, but then it's become commercial lending, business acquisition lending,
Yep.
buying all ranges of properties, agri-finance. So we're sort of doing a bit of everything, which has been great.
And you do small stuff as well?
Oh, yeah.
Car loans, is that
I always I think the amount it definitely comes into it when you're talking strategy, but like from little things, big things grow. So some of our clients started off with one or two small loans, and then when you get a feel for how each other works and you see what they're trying to do, it could end up in something bigger. So yeah, we just treat everyone the same, and a
Right.
few equipment finance loans get thrown in there, just to kind of help everything keep moving for people.
Yeah.
It's
And
good.
again, as we mentioned before, like there's a difference between really good sort of brokers or lenders and the not so good ones.
Yeah,
And then from some of our clients, we get feedback on they've had bad experiences
yeah.
and then they've had really good experiences.
It is like,
It is really different.
I think probably the biggest thing I've learned with that is if you are across how lenders are going to treat someone, and you can sort of like mitigate issues ever coming up. So not submitting deals that you're not 100% sure are going to go through. You know what I mean? So
Yeah.
that was when we sort of got into the industry. It's maybe that financial planning backgrounds where you would never take something somewhere unless you knew it was going to work. That was maybe how we kind of approached lending. So you meet with clients, you get a feel for where they're at, you work on all the numbers just between you and them, and that's a very friendly environment. And if you can get an outcome, that's when you take it. If you can't, then you might need some more time. You know what I mean? And that's never a bank declining you. Then it's maybe not now, but in the future sort of discussion. So yeah.
Hey,
Mm,
it's a really good insight.
yeah. So that whole kind of like borrowing capacity, pre-approval, like it's kind of, we're just doing that ourselves with you rather than taking up to a lender level just to sort of be told no, like that it's all good when you're signing an application form, not when the lender says so, sort of thing,
The latter end of the stage.
Yeah, it's horrifying stuff, yeah.
I suppose we'll probably have a chat about a heap of stuff, and I dare say a lot of that content will provide a lot of quality to listeners.
It does flow, yeah. Like a lot of the points, I know we've got some notes down. It's like, variable fixed rates, purchase costs, what lenders are doing. It transgresses from like huge commercial purchases to a first home buyer attacking their first thing. So we've made some really good notes, but given how good we are at chatting, I think we'll naturally cover it off. Yeah, it's good.
John, start us off. You go. Put him under the pump now.
Yeah. Hit me with a couple question. Yeah.
Well, we wanted to know I guess you said you've got you kind of know what's going to happen when someone comes in because you're talking to the banks, you have an idea of everything in the background.
Staying across the banks,
Yeah, and I guess a lot of people, and we're talking about it before, maybe starting to think about, fixed rates, or is it better to have like a variable rate? What thing?
We get that question a bit, yeah.
It does come up. A lot of the listeners will already know, so appreciate this might drone on for a second, but just re-explaining what they are is a good place to start. Generally in home lending, you can set up your loan to be fixed or variable interest. The loan term for like normal home loans is usually around 30 years, and you can make that shorter if you want. But then essentially what you're doing when you're going variable is you agree, I'm going to take this much money out over this amount of time, and the rate when I start the loan is here, but that rate is at the whim of the market. So it can change. It can change on the first day of my loan, might stay the same for a while, but whatever the sort of country's economy's operating like, if, big red hair drops bombs somewhere, like all these like sort of
financial melt,
external factors can come into rates changing.
So kind of like a lender beware.
Yeah.
This rate you're getting will not last the
Exactly.
5 year. Okay.
Yeah. Yep. The thing with that is usually to get into the technical side of it, most banks will sort of follow the Reserve Bank of Australia set what's called a cash rate, and they make announcements on that really regularly. So banks will sort of follow what they're sort of saying in most cases. Banks kind of like going out on their own against the RBA. Generally, people start jumping ship because obviously if one bank's going up but none of the others are, then it's not a good sign for that bank. So you see rates track pretty much with what the country's sort of saying. The really cool thing about variable is the whole thing is based on flexibility. The rate is flexible, but also you owning the loan, you have flexibility in that. So That's like make as many extra repayments as you want.
Handy.
You can sort of redraw those extra repayments you make. You can keep money in offset. So like a transaction account next to your home loan, the bank will calculate your interest every day, and whatever's sitting in that transaction account kind of comes off that calculation. So another episode to go in the nitty gritty of those, but
we'll cover it.
Yeah, we get it. It's all about flexibility. One of the big things too is you can move the loan, you can change banks. If you sell the house, generally you're only up for like sort of small couple $100 exit fees.
Yep.
I'm making it sound really good, but let's talk about fixed. So fixed, on the other hand, you've got that 30-year-ish term. You can sort of put a chunk of that into a fixed period.
Yep.
And what that means is day one of walking into the bank, you agree on a rate and you set a sort of 1, 2, 3, 4, 5.
So max you get on the fixed term
It's usually about 5. Yeah. Some lenders will go longer, but most will sort of, I suppose you're predicting an extreme amount of time. You know what I mean? You're hedging a bet against an extreme amount of time, but that rate you agree to on day one then is locked in, and that is set for that period of time. So let's say 3 years, your repayments are going to be exactly the sort of minimum repayments are going to be exactly the same. That is ticking a lot of boxes for people who love sort of certainty in their life.
Solidarity and payment requirements.
Exactly. Keeps everything on the level, like you just know always what it's going to be due. You're not going to be watching the nightly news stressing, hopefully. So it can tick a few boxes that way. The kind of negative to it, I suppose, or con, is they limit your flexibility. So the big thing with fixed loans, you're kind of agreeing to a period of time with the bank. So if you try and leave or pay extra or alter the agreement, then the bank will kind of, sting you. And it's an interesting stinging because the technical sort of side of it is if you enter on a fixed rate and you try and exit when the rate is lower than what you entered in on, that's kind of where the bank said, hang on, you agreed to stay in this for 3 years. That was going to be this much interest to us. Now you're leaving because you can get a better deal somewhere else. And they look at pretty much charging you the interest you would owe them for the end of that term. So if you left a year into a 2-year fixed term, then you'd have to pay full years of interest almost, based on the difference of when you enter and when you leave. So it's a complicated calculation, but it can be really expensive. On the flip side, if rates go up and you're at a fixed rate, you've won out, I suppose, because you're paying less than the rest of the market. And leaving under those terms, generally, like someone is treated differently, but if you're kind of leaving onto a more expensive rate, because they can sell that debt on for that higher rate, they're kind of happy that you're doing that. So exit costs don't apply as much, but fixed rates, that certainty, variable rates, flexibility. What do I do? Anyone who sort of tells you they can predict the rates is lying, to be fair. No one's got the crystal ball.
Fair assumption that, look, banks usually will offer you something that will probably favour them. So would that be fair to say, look, a fixed rate is as good as it is, you mentioned it ticks some boxes for some people.
Yep.
Banks will usually try and get a good feel on where the rates might be going. So,
Definitely, yeah. They pay like economists significant sums of money to do that. So whenever a bank is sort of releasing fixed rates, those fixed rates, they're kind of saying 1 year, 2 year, 3 year will all have independent rates.
Yep.
And that's the bank's internal like economists working out where this sort of variable rate is going to go over a period of time. Banks don't want to sort of, discount rates exorbitantly because then they're putting themselves at risk of, not earning as much as they could in the variable market. So a lot of it is, based on economic predictors and the economists who work in the bank putting that together. But even like on a normal base level of winning consumers, they will, do like a rate discount to bring in new customers. So 2-year fixed rate specials. So that's all stuff that we look at. And it's always about, what am I more comfortable with? Because predicting the market is, if we could do it, we probably would be on a podcast, would be in our yacht in the Caribbean. But predicting the market is very difficult. So the idea is you kind of go more with what's going to make you comfortable as a person, I feel. And then we kind of put that in a comparison against the actual costs. So you start there, look at the costs, make an informed decision, and see what sort of suits you best. Just to make it even more confusing, the what we're sort of seeing a lot of is you can actually split loans. So
Yeah.
yeah,
Okay.
you
Yep.
might traditionally have you got your house, you got one loan under it, and that works really well for a lot of people. But you can almost put a foot in each camp. I don't know what the rate's going to do, but I'm keen to try it out. Plus, I've got, some money to pay my loan off faster.
Yep.
So I don't want to lock myself into something that doesn't allow me to do that.
Fixed half, variable half, that kind of thing. Do the
Exactly.
banks charge you to administer that and their fees and costs and
Yeah,
that?
no, generally it's most banks will sort of charge a single
Okay.
package fee.
Yep.
So like I think if you go crazy with splitting where you're getting to like sort of 6, 7, 8, 9 accounts, banks would probably be like, what are you actually getting up to here? But in most cases, 2 or 3 times, then your sort of package fee over the top of you as a customer kind of covers the fee for any of those accounts. So you're not like that's not always that's where brokers come in. We can actually look at that for you, but in most cases, you're probably not paying extra fees to split a loan. Yeah.
Interesting. I think on what you mentioned, Jess, you've got some clients, and I've had a couple that have come off really good fixed rates.
Yeah.
Like they might have been able to fix 3 years ago. Some have been 4 years. I think. Have you had a
Yeah.
couple come off? So that.
Yeah, we had a lot, I guess, recently that fixed their rate during
The golden
COVID.
era.
Just
Yeah.
So they're coming off the juicy like high twos, low threes.
Yeah, some people even like that.
Yeah.
Like even below 2. So yeah,
Yeah, I had a
Heavenly.
1% the
Well
other day. Yeah,
Yep.
1 point high. Yeah.
Have they just had you find? I dare say the banks have reached out to them. Hey, your new variable rate or your new rate is like mid fives, low sixes. How did you find? Are they sort of mentally wrapped their head around that my payments are going to go from $3,000 a month to $4,000 a month because of the jump in interest? Is that
I think they read it, but maybe it doesn't click
Sink
until it
in.
actually
people? They're
happens.
like
Yeah.
bang to the side
Yeah.
and they see their minimum repayments skyrocketing.
Yeah.
Most people don't understand too, because I guess when it kind of rolls over, but they're like, do I need to make a decision? Do I need to
Yeah,
change?
it's a big deal.
And they don't understand what's happening. And
Again,
then
the banks will, and look, correct me if I'm wrong, it's not to say that everything about the banks is bad, but sometimes they'll offer you something, and if you don't discuss it with them,
Yeah.
that
It might
is
not
a-
be the greatest deal you ever
correct,
get.
yeah, you know,
And it's like it is in today's world to get a sort of single email with colors all over it, like your brain almost just files that away without any level of importance. A letter in the mail, like people aren't sort of really not. I'm generalizing. It's easy for someone to miss that important document. So generally, banks send it like about a month before your fixed rate expires, correspondence to sort of say, hey, this is coming up and this is what's going to happen. They can't really like accurately give you a rate super early on in the piece, but we sort of start looking at it for customers about a month and a half out. And big on that budgeting aspect of it, of course, if you're going from a really low rate to a really high rate, your minimum repayment is going to jump quite a bit. If you've kind of, accounted for that, a lot of the time the loan balances of old are a bit less than what we're sort of seeing new customers taking on, then the repayment side of it might not be as horrific. So then it's more about, well, this is a really good chance to review who I'm with and if I can get a better deal and pull all those like classic levers of I'm gonna leave you, you like give me a better rate and they drop their pants a little bit. Yeah, that kind of arguments get the banks fighting for your business is a good point. Yeah.
Yeah, that sort of goes along the line of the questions when we're talking about this. It's all well and good to look at all the banks and say the percentage rate, but like, would you sort of discuss with people about sometimes you might need to look beyond what percentage rate they're
Yeah,
offering?
for sure.
Like
I think cost, like this
specie costs and stuff.
yeah, this discussion comes up a lot. I like cost is the most important thing, let's be fair. Anyone who says it's not is kidding themselves. So interest rate definitely weighs in almost more than anything else in the discussion, but you would be silly to not look at all the other components of the loan. And that's often, I spoke about the package fee thing earlier, like banks will sometimes charge fees for products, home loan products that is. So
some do charge more than others.
some charge more than others, some don't charge them at all. So it's like your rate might sort of reciprocate, $2,500 a month payment, and then you've got a $400 a year fee. So that's sort of $35 a month goes on top of that, and then you compare holistically based on who's charging what where. So it's not so much looking just at the minimum repayment, but also, what fees are going to be attached to it and how much they end up totaling.
Okay.
Some banks will, and it's all about how you want to set it up. Like it's that promo thing where, one lender might run a promo where they'll do $0 fees for the life of the loan. Their interest rate might not be as sharp, but when you kind of look at them holistically with the fee included, then you can actually be sort of more of your money's paying the loan down than paying fees, so you can be better off. So all those comparisons come into it for us when we look at things, and it's like those choices in terms of fees, like not only what you kind of have the facility, but when you're intending to leave it. So some lenders will charge higher, kick you on the bum on the way out fees. So for someone doing like a property flip, you might choose a lender that is going to be less on fees, maybe a little bit higher on rate, but because at the end of the line, they're going to get rid of the loan pretty quickly. So they need to be able to get out quickly. So yeah, fees definitely come into it. And then I think the fees are generally associated in home lending with offset products most of the time. So if you kind of like to keep things simple and offsetting is not for you, and it's just like a simple redraw account, then you can almost like waive the fee and just go for like basic products. So a lot of the time, those basic products, can tick all the boxes for people. So they're the comparisons that we do for sure.
And can I ask, like, because I guess there's all our listeners, some might be first home buyers.
Yeah.
They don't really understand, offsets and redraw accounts and what's the benefit of both, I guess. And risk and cons.
Yeah, to go into those a bit more for sure. So we've been talking about fixed variable interest rates, the interest rate that's given to you by the bank, you obviously have to pay out the loan that you take out. So let's say a $500,000 loan, you have to pay the bank back $500,000, but they'll put an interest rate on that money. So not only are you paying back the principal, but you're paying back any interest that accrues on that principal. So with the aim of the game being to reduce the amount of interest you're paying the bank, there's a few sort of additional like products under the home lending banner, like redraw or offset, that can help you avoid the interest charges or sort of reduce them. So I mentioned it quickly earlier, but offsets, they're a transaction account that sits alongside your home loan. Whatever the balance is in that account, when the bank does an interest calculation, which they do daily.
Dirty daily.
The daily, yeah. They generally charge them monthly, but every day they'll look at your loan, 500 grand owing, you made your minimum repayment, it goes down slightly. 500 grand owing, 50 grand in the offset account. We only calculate interest on 450. So offsetting can be really helpful to reduce interest, because if you're sort of sitting on the cash, then a lot of the time those standard transaction accounts at banks don't really do much for customers. Like they don't return an interest rate or anything like that.
Correct.
So it feels the same as a person. It's money in your bank account, direct debits, it's just your money. But then in the background, it can be sort of a bit of a powerhouse for you.
Do you find that with some of your clients, Jesse, you're having a chat to them generally, hey, I've got 50 grand in my savings account earning 4%, and I've also still got 500 grand owing on my home loan. Oh, do you have an offset redraw? Yeah, I do. Do you ever sort of outline the differences between the two? Like a savings account and an offset redraw?
Yeah. People have money in their savings accounts. Actually earning any interest.
Yeah, definitely.
And then when you tell them, if you just transfer the money into this other account, an offset account, you can save thousands of dollars in interest.
What about like an offset or redraw versus like a high interest save up or
like a high interest savings account?
Yeah, how would you sort of compare the two? Do you sort of outline that?
Yeah, well, I guess like a high interest one, you might be getting like what, 4.5?
Yeah.
4.5 max I've seen, yeah.
It's like, I think when we look at it with customers, we're not in the position of giving advice. It's more just providing information. But with one of the big things, and most of the listeners, will either work with an accountant or if they lodge their own tax returns. When you do your tax return at the end of the year, you might notice there's that component of like bank interest earned. So yeah. So you kind of
taxable though.
Yeah, it is taxable. So a savings account might be sort of paying you 4 or 5%. If you can get them in like a nice healthy term deposit, maybe that number goes up. but at the end of each year, whatever you sort of earned off that savings is actually added to your taxable income.
Right.
So the trick with offsets is you're not actually earning any money, you're saving it. So
That's right.
the rates are slightly higher generally in home loans compared to savings. So, I guess if you just look at it on a flat value, you're probably getting a bit of a better rate in home loans. That's not always the case.
One's got a higher rate, usually it's your mortgage rate,
Yep.
and it's also tax-free.
Yeah,
Especially
exactly.
when you might have families that have had a mortgage for a while, they might have saved up 50, 80, 100 grand or whatever. Put it in the savings account because that's where I think it might be to do its best.
Yeah.
When you look at the net value or the after-tax value,
Yeah.
one is usually a lot better than the other.
Yeah.
And you find an offset is still quite accessible. You can literally reach in, log in online, go, hey, I need 20 grand to fix the aircon.
Yeah, it's just your money. Yeah.
Yeah, okay.
I think on offsets, to kind of summarize, while interest rates are high, we're sort of, it's about 5.4, 5.5 for home loans at the moment. It is a really valuable tool for people. Banks are kind of, listening to that, and they're trying to get more attractive in the offset space by potentially offering multiple offset accounts. So some banks will only let you have one transaction account, that's your offset, but more commonly now banks are letting you kind of have up to 10. Yeah, several. And that's like, I think we've all, someone who's sort of read that Scott paid 4 buckets. The days of a single bank account are almost over for a lot of people.
Yeah.
So you got money coming in for bills, money coming in, then an account to pay bills, an account for saving, an account for holidays. Like you could potentially have all those offsetting a loan. So
pretty sure I do.
yeah, and then with savings accounts, more traditionally people would only have one. So that sort of $1,000 here, 2,000 here is doing nothing for you. Only the savings account is doing something for you. But with linking those up as offsets, you're kind of getting value out of every cent, I suppose. So that's a handy one.
We like offsets. Offsets are
just
for the right person.
Yeah. And like I said before, the offset is generally what accrues the fee. So it's a balance of, if I'm going to be paying a fee, $300 a year for this thing, will I be holding enough cash for it to be valuable? And that kind of comes in, like you look at the tax impact, you also look at the fee impact versus the rate. So there's a few numbers that, that are worth considering. Redraw, to answer the rest of your question, it operates in a really similar fashion. It's, instead of the money sitting in a transaction account, you're actually making the repayment onto the loan. So if you've got a loan of 500 grand, you pay $5,000 onto it. The loan sort of then goes down to 495 before they start charging interest, and then that's what the bank will do its calculation on. So it's just a step beyond offset. You're actually manually making that payment onto the loan, sort of thing. So
restrictions to take money out of.
Yeah, it's these days I can sound like a bit of a fearmonger here, so just hold me up. In all the bank disclosure documents, they say that they can sort of switch off redraw at any time. Historically, no one's really done it much. The only time that it's actually happened in recent cases, it's more around banks doing electronic updates to internal systems, and even then customers just riot in the streets. So I think the idea that they're going to stop you from accessing it, it's not something to really ignore, but you know what I mean. It's not like it happens every week, is what I'm trying to say. In most cases, it's just a simple online banking, take it out of my loan back into a transaction account.
Yeah.
But it's worth understanding all avenues of it. So if you really value flexibility and that access to it, offset's probably better for you than redraw, so to speak.
Yeah.
So just a couple more to sort of tidy off on looking beyond the percentage rates that banks offer. A couple of things is there much benefit, or do you see a cost benefit between online only banks and physical branches, like the classic banks? I guess the big four have got a lot of branches around.
Yes.
Plus a few of the others, but there are some lenders out there that are purely online. It's either a phone call or an email, and that's what you get. Do you find the cost reductions they have in not having face to face, is that saving a lender a borrower or something?
I think in general the saving is passed down. If you look at a comparison between banks as we do before we present to a customer. Down the bottom end of just the entry level rates, you'll see those online only banks, Macquarie, ING, some of like the credit unions, like, so not having to fund branches obviously is a big cost saving for a bank.
Let's say the bottom line a little bit.
Yeah, the big thing as well is like a lot of I've named ING, they're one of the biggest banks in the world. So I think that concept of if I lose branch access, am I going to be able to work with my bank? The banks that do online only focus on offering a better online experience in most cases. So it's always a question of like, when did you last walk into a branch? And if that answer is like a week ago because I needed to do this, then you'd be like, maybe branches work for you because you're in there, you're using them, But most people, it's years. Like, and when they do have to go in, it's like almost a resentment, line up in that line, someone's like coughing behind you, you just feel icky and gross. Yeah. And that's like, people naturally peel away from cash. A lot of online only banks might sort of reduce the impact of ATM fees or something because that makes it easier for their customers. So there is some value in them for sure. What I was saying, when you look at them by comparison, they do sit down the lower end, but with sort of big four banks, we generally kind of play within that tier one, big four, and then like more banks the name of in most cases. The reason being is because policy is generally a bit more favorable to the customer. If you're dealing with like smaller lenders, small online only banks, potentially the policy can be restrictive. So if you walk in and it's like, we've both got pay slips, we don't spend a crazy amount of money, everything's super clean, then sure, that bank would work for you because you're just fitting in a real standard person. But if you're thinking, I'm thinking of opening my own business, like in the next 6 months, then tying yourself to someone who's not going to support the future you might not be a good idea.
No point.
Yeah, so beyond rates, it's very like, you might be able to get a cheaper rate, but we can also as brokers sort of present, hey, this online bank is offering this rate, but the customer's potentially going to bring business banking over, and one of the big four might come to the party a bit more. So it's, part of our job to get banks competing for your business. So whatever they sort of just putting up publicly isn't the be all end all of where you get to on their pricing. We kind of get stuck into that for you. So I think it's a big mix of whether an online only bank works is whether you like branch access or not. That's a big question. But then our like research into them as to how well their online system functions, because that's all you really have. So
Next question. As a non-percentage rate thing, pretty much most people either use their phone, tablet, laptop, computer. Also the online, are you finding have most banks caught up? Is there still a big disparity between the big?
I think slow. Yeah, I'd say like of that sort of tier one group. You're not really like, there's not huge disparities between the online banking portals, but there is still some banks, like I suppose, hanging back. It's things like ability to say create an offset account, bang, done. Like it's making that simple, keeping you off the phone. So in general, like, I mean, it's all about who you are as a person. If you know you're going to use something more because the bank's flashier, that'll come out in our discussion. So we'll make a call based on that. If you're just a cost saving, it can be a black and white, look like the Matrix, as long as it's going to be the cheapest, then go for it. So it's a personal preference.
It's insightful because I guess you're seeing a lot of banks, what they offer versus costs. It's no doubt listeners got a little bit out of it.
For sure. And definitely just, sorry to cut you off. That sort of, if you haven't thought about it for a while, or, it's something that you haven't really looked at, or you want to know what's out there, it's definitely something, any reputable sort of broker in your area, even getting on to your bank and having a bit of whinge can go a long way. So it's worth doing.
They'll use Jesse's voice.
It's just not good enough.
Do you bank every week, J-Mac?
Or Dan.
Excellent. Yeah, do you use your wheezy voice with Dan as well?
No, we do a good thing because we both dislike the bank. So I suppose we can talk happily to each other and let me sort it out. Yeah, that's it. Too good.
All right, then.
Thanks.
We'll do for sort of that one on the comparison, but we're definitely going to cover a fair bit more.
Yeah, love that.
But that provided a fair bit of insight that people might not be able to see on advertisement or just reading between the lines, especially for yourself. It's kind of like us with like super funds or managed funds or whatever.
Yeah, there's so
We
much
see a lot of them, and
Mhm.
you see a lot of banks, what they offer, what they charge, how they work with clients. Yeah, cool. So thank you.
Being on the pulse, yeah, that's it.
Yeah. All right, homies. We'll see you in a bit.
See you
Ciao.
guys. Thanks for having me.